In this presentation, we will compare a payroll report to the income statement or profit and loss so we can tie out and reconcile the expense accounts that are recorded to the payroll report within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our S-Corp paid payroll file. We're going to go down to the reports on the left side. We're going to open up our income statement report first. So we'll open up the income statement, scrolling up top, changing the dates from 01/01/19 to 03/31/19. That's going to be the first quarter. So January through March 31st, and then we'll run that report. Once again, January through March, the first quarter 2019, and run that report. All we have done in this QuickBooks file is process payroll. So all of the activity in this income statement will be related to payroll. If we scroll down, we see our major two payroll items. The wages is going to be pretty much payroll expense. And then the taxes are the employer portion, as we have seen in the past. We have these two items, the retirement and the health insurance. These are benefits that are being paid over and above the gross pay and therefore are broken out in their own expense accounts. Let's go ahead and run another report. So we're going to go and duplicate the tab up top by right-clicking on it, duplicate that tab, pull the one from the left to the right. So now we have the profit and loss and a new tab. And then we're going to go down to the reports on the left side. We're going to scroll down to the payroll. Within the payroll reports, we want the payroll details. So we want the payroll detail report. Then we're going to scroll back up top and we're going to make sure to change the date, or we will change the date, from the last date to the quarter. So we want this quarter, January through March, and run that report. So this will give us a detailed check by check. And if we scroll down to the bottom of it, we'll get a summary report. So this is going to be a summary breaking out the regular pay, the OT or overtime pay, the salary, the bonus, and then the S Corporation's 4,000 specific to an S Corp owner. All of these items are considered part of compensation in some way, according to this report. And those sum up to that $311,708.34. If we go to the profit and loss, then if we go back to our profit and loss, we got that amount here at the $311,708.34. So this amount will be then the gross pay. If we go back to our report, the second tab, then we have the 401k, the medical insurance, the HSA, and the garnishments. These are items that were pulled out of the gross pay. You'll note that we do not see an expense item related to them. If I go back to the profit and loss, we don't see any separate expense item. We have the retirement plan and health insurance, but those don't include these items because these items are included in the wages. They're part of gross pay. In other words, they were taken out of the employee paycheck. In theory, they were paid by the employee's money, not by the company's money. It was paid by what was taken out of the employee check. So if we go back then to the second tab, these items were pulled out of the wages and paid directly for the employee. Then we have the FIT, federal income tax, Social Security, Medicare, California taxes that we won't get into a lot of detail on because those will vary from state to state. And that's going to give us the total taxes. Again, these total taxes, it's deceiving because these are taxes, and we would think that if we go back to our report, notice that's 144,418, back to the profit and loss. We have the profit and loss. That's not included here in the taxes, obviously, because that's a much lower number. Why not? Because those taxes are included in wages. They're paid by the employee in theory. So the employee earned money. In theory, we took that money out and paid it for the employee, and therefore they're not taxes to the company, not a tax expense on the books, on the income statement for the company, but part of wages to the employee as an expense here, which we just happen to be required to take from the employee and pay to the Fed and the state for taxes. If we go back over, then you might say, well, what is that taxes item? That's going to be the employer side, which includes the FUTA, the Social Security, the Medicare, and the California taxes or state taxes for the employer side. So these are the employer taxes. These two are matching taxes. FUTA is an employer-only tax. That adds up to the $1,550.88. If we go back to the profit and loss, then of course, that's the 1550.88, just the employer taxes being reported here. Then we go back to our report again, back to our profit and loss, or back to our payroll report, and we note that we had those other kind of strange items, those other two items that were just kind of hanging out there in a separate area, not in payroll taxes or not in payroll expense, and that's the 401k and the Medicare, medical insurance. Why? Because this is the employer matching, not the employee portion, the employer matching. And the point of it is that the matching portion isn't going to be part of payroll taxes or part of any tax calculation for payroll tax. And therefore, it's not included in the gross pay. So note, this number then is the gross pay, which is actually low because the employee actually got paid more than that. They got paid that plus these two amounts. These two amounts just are not going to be part of the payroll calculation or the net check calculation. They were paid directly as benefits. So these amounts aren't included in payroll but have their own expense account. The 401k, medical insurance, 3601, 330. Back to the profit and loss. Here are those two expense accounts. So that's how we can basically tie out the income statement, and we should be able to do that. We should be able at the end of the year to basically take our income statement, tie it out at the end of the quarter, and tie it out to our report. And we've looked at our report, and we should be able to, and have looked at how this report then ties out to the Form 941, the quarterly reports, and in a similar fashion, we'll tie out to the year-end report, the Form the Form W3 and W2 reports, as well as the year-end FUTA filing, the Form 940 at the end of the year. For more accounting information and accounting courses, visit our website at accountinginstruction.info.